afternoon, everybody. My name is Matthew Britten. I'm a partner with PwC Bermuda, where I serve our insurance and reinsurance clients from both a assurance and advisory perspective. Obviously, I'd like to start off by thanking each of our expert panelists for kindly agreeing to share their perspectives today around this particular panel's theme of Fit for Growth, during which we'll explore topics including measuring performance and where to grow and invest. So by way of introduction, to my immediate left, we have Michael McGuire, Chief Financial Officer of Sompo International, a wholly owned subsidiary of Sompo Holdings Incorporated. To his left, Mark Lyons, Executive Vice President and Chief Financial Officer of Arch Capital Group Limited. And then Robert Qutub, Executive Vice President and Chief Financial Officer of RenaissanceRe Holdings Limited. Welcome to you all, and thank you again for taking the time today. We've already heard today a number of perspectives, including how the reinsurance cycle may move towards increased certainty and sustainability in pricing. But could I start off with asking how your respective outlooks for 2018 and beyond for the industry have changed from before the recent catastrophe events to after the recent catastrophe events, and specifically how that change in outlook impacts your priorities as CFOs.
Sure.
And Michael, could I start with yourself?
Well, good afternoon, everyone, and thanks for coming back after lunch. The outlook that we have at Sompo International is quite an ambitious one. Pre-event, we had been embarking on for several years a pretty substantial organic growth and M&A growth strategy to build a much larger, more diversified organization. And that continues today, post-event. What is important as we think about the impact of these events, I don't want to repeat all that's been said earlier. Clearly there seems to be a widespread need for increased rate. Our priority will be to focus on getting the rate that we think we need in many of our business lines, not just property, not just catastrophe. But it is important from my perspective and our company's perspective that we build a business that is durable and sustainable through the course of a market cycle, whether we're at the peak or the trough. I would echo on some of the comments that were made in some of the earlier panels that I do think the peaks and troughs of the market cycles of the past are likely to be less steep and less deep on the upside and the downside. But that makes it much more important for finance organizations and company operations to be more efficient in how we source business, how we produce business, how we administer business, the technology that we use, how our intermediaries distribute business. Those are all priorities outside of the need for rate adjustment in many lines that have been suffering from underpricing. The need to continue to grind expense ratios lower, I think needs to be an overriding strategy and philosophy, irrespective of the fact that the absolute rate for risk needs to change based on the events in the last, I'd say, 10 years of rate deterioration.
Fantastic, thank you. Mark.
Thank you, Matt. I guess it really depends on what week you ask me. I mean, there's before the cat, then after the cat. Immediately after the cat, I think everybody was a significant level of buoyancy. Pretty optimistic. I think we were more down the middle of the road on that. I think we've got a few data points. We've got farmers had a large increase. I think you've got SCORE, perhaps with some, but you also have Markel's Catco recapitalizing, $1.8 billion. You've got flow in and out that may mute some of this. But to me, I always view the property sector, I'll just focus on that for a minute. I always call it the tip of the tail wagging the dog. So retro market, which is the tip, kind of affects those capacities and pricings first. And then it impacts reinsurance, then it impacts the primary sector. Most lines of business don't do that, of course. They have ownership of it, where this is trickled down. So nobody really knows the extent of the hit in the retro market at this point, but both the direct retro market and the retro unretro market. And that kind of supply and demand imbalance, I think, is really going to be the driver that really changes things in that sector. Unlike others, I don't see a lot of spillover into other lines of business. It just wasn't enough of a capital event to cause that. I think there's a debate of exactly how big these losses are. which maybe we'll get into at some point. But coming in pre-cat, we would generally expect a lot of lines would be fighting to keep the same loss ratio, so there wouldn't be margin compression. And some we thought could be some margin expansion areas, but basically status quo from the prior year. This dynamic will change things, but we're in a more wait-and-see attitude. We only have a few data points yet, but we're ready to react no matter how it manifests itself.
Robert.
I guess it's me next.
It is.
No, well, first, thanks for coming back from lunch. I appreciate that. But all very thoughtful things that I would echo that my colleagues up here said. The thing I would fall back on as the last part of your question is what has changed in the role as CFO? I would say probably nothing, and I mean nothing in the context of, am I looking to return capital? Am I looking to deploy capital? I think on our last call I said we were looking for more opportunities to deploy capital given what we've been talking about in potential rate increases. And that I think is very important. Am I looking to manage costs? Absolutely, but there's a cost to do the right thing. So I'll spend money where I need to, but also grind out efficiencies that are out there. And it's collective effort across the company. The third thing is still trying to figure out what the 2018 budget's going to look like as that season's upon us. But there is a lot of uncertainty that's out there right now. But I think the one thing that as a CFO for the company is to maintain the course, continuing to face the same challenges, but they're different ends of the continuum this time than they were maybe 12 months ago and how we look at it.
Great. Well, leading on from the points that you've spoken about there in terms of uncertainty, obviously Jan 1 is expected to shake up to be a very interesting renewal season. Obviously there is the question of rate increases and how widely they will spread. But could you each provide some perspectives on what maybe some of the other questions that you're waiting to be answered through that Jan 1 renewal season?
Well, yes, maybe I'll start. As a buyer of reinsurance, we have a lot of reinsurance treaties, but they're spread throughout the year. I think one of the earlier panelists on the reinsurance panel suggested the existence of multi-year treaties. We benefit from a lot of multi-year treaties that give us some time through most of our treaties through 2019. So that, from a buyer's perspective, puts us in good stead for the portfolios that we manage. On our reinsurance business, where we're providing capacity, 1/1 isn't the only renewal date, obviously, but that is a critical renewal date for international exposures as well as retrocessional protection. And that seems to be where some of the most immediate disruption will be in the retro markets given the collateral lockups. Mark, you made the comment about some of the ILS funds reloading or raising capital. It's not clear yet how much of that capital will be incremental new capital versus just replacing the capital that has been lost or just the collateral that happens to be locked and cannot be deployed for some period of time. And so as I look at early signs for the January renewals as a provider of reinsurance, I think the early signs are good ones. Mark, you mentioned a couple of the key renewals that we've seen as well, that pricing even for non-loss exposed accounts have gone up 5 to 10%. Our expectation for reinsurance, particularly for property and cat, is that for non-loss business, we would expect a 5 to 10% rate increase. Loss affected, it's going to be much more than that, depending on the client, depending on the layer. But we're certainly focused from an underwriting perspective on making sure that for the amount of rate that we've given back as a reinsurer over the last 5 to 7 years, the amount of rate increases that people are talking about don't even put you back to where we were in 2012. So even if there is a substantial correction, if you call a 25% correction, that only gets you partway back to where the industry probably was in 2012. And so I think it's a good first step. The fact that we now have a much bigger spotlight on all lines of business, not just the cat lines, I think is an interesting one. One of the things that one of the earlier panelists discussed, which I think is quite important, is that the industry for so long has relied on the margin from cat being an offset to declining margins almost everywhere else. And the fact that those cats have now come back, not wholly unexpected, but reasonably large losses, it just puts a spotlight on everything else that isn't working as well as it needs to. And that, I think, is an important driver of of sentiment on underwriting desks and behavior in the marketplace. And the early signs are good ones, and we'll have to keep looking at the renewals as they come up and how do firm order terms come out, are covers coming up short or not, and it remains to be seen. But so far, the early signs are reasonably positive for reinsurance renewals.
A lot of good points, Michael. Your comment about the industry's been subsidized really by some of the cat losses, and that's all well and good until you get hit in the mouth. And that's exactly what happened. And then if you're overexposed, it hits you disproportionately, and deservedly so. I think another point you made is you got treaties throughout the year, and as do we, and I'm sure you do as well. We purposely, over time, stacked it so we had our inuring covers to the cat, whether it was wholesale-driven, retail-driven, tech risk businesses, whatever is really subject, to be like November, so we couldn't be leveraged. That we were in the leverage seat rather than the reverse, because we're buyers and sellers, as you know. And one other data point I can give you is that the November 1st quota share that we had for a lot of the U.S. businesses was only marginally different. Now, we ceded losses. It's a quota share, right? We ceded losses to it. And it has a material occurrence limit within it, which is actually the first, I view that as a cat cover. It's inuring to the true cat cover, but it's first line of defense. And that really didn't change. Now, as a buyer, that's fabulous. As a seller, makes me a little bit of a pullback, which is why I'm not as a bullion. I'm just, we're ready to react, depending on what happens. So the data points are mixed, I think at this point. And I think it's fair to say that we're in the cheating phase of our cat declarations. And you probably heard this from earlier panels, I would guess. But at first you get some of the modeling agencies between RMS and AIR on Maria. I mean, their intervals don't even overlap. So that's very encouraging. And so it's really not as clear. And I think Dowling's most recent report out had about $41 billion that they could accumulate, and you throw a little bit in for some of the ILS funds, maybe you're getting into the mid-60s. And most people were reporting 75 to 110, I think was kind of the range. So where is it? So it's possible the models are wrong and the market shares are wrong. Well, the models are always wrong. It's a matter of degree. So I just think that the reactions that people are going to take and the things we're looking for are really derivative from what they post and what the industry gravitates to, or what those losses actually are on an industry basis.
Yeah, that's a great perspective as we were thinking about it here, going into the call last week, thinking about the top three questions that are out there is, one is how are these events going to unfold? There's a big gap. I don't know if Ian's out here, but I heard the whole conversation on where's Waldo. I think Waldo's starting to present himself a little bit more, and we're getting a better clarity on the gap is closing, but there is a gap out there, and I think that's probably natural, but more clarity is being provided on that. And it helps us address the questions I think that Mike was addressing was, how much will rates go up, and how will we react? Insurance Insider came out today, I think, and said 15 to 25% on the U.S. cat. Okay, does that feel good? No, I'll ask you. Better than it did last year, I guess, is probably how we feel. I think when I look at, how long is the duration going to be, that to me is probably the one that consumes most of the conversation, at our shop, in the sense that this is, the cyclical versus secular, and what will this do to 18 and 19, and how will this play out? And the third piece is, I think it was talked about this morning, it was either Kevin or Mike was talking about how far away from the center will this impact, the cat? Will it go in, spill into other lines of businesses? Those are things that we are, classes of business, sorry. Those are things that we're focused on. We think there'll be an effect on all three. We're positioned and we're optimistic about that. We also believe nothing will be as soon as you want or as much as you want. It'll take longer and being more patient, which is why we've been on the retro side. We're watching to see what happens at 1/1 and what the real pricing does there. I mean, we've been a huge user of it, and it's been cheap capital for us, and it's proved very well in our gross to net strategy. We feel good about that, but as the pricing goes up, we'll trade the other way in that, and I think that can help, one, overall returns, but it also can allow us to deploy capital, but it also creates some more volatility in our earnings stream. So as again, we sit, we patiently wait, and we're waiting to see, and someone once said it'll never be as good as you want it to be, and it'll never be as bad as you're afraid it might be. So,
great, thanks. Mark, you were touching on, I guess, vendor models sort of earlier on a little bit in your response. Evidently, with Maria, we saw a very different industry loss range coming out of RMS and AIR. From that perspective, are there some key lessons in there in terms of reliance on vendor models for reinsurers and primary insurers?
It's a great question. We're looking to see what they are. As you know, the damage down in Puerto Rico is enormous. There's estimates that power won't be returned until spring, in some estimates. So the reporting is very light. When you contrast that to Irma, where our reporting is actually a little faster on Irma than it is even on Harvey, but it's I won't say non-existent, but on a relative basis, there isn't enough knowledge yet for a lesson for me to really answer that.
Anything to add, Mike?
I would just add that for Puerto Rico specifically, that probably caught many in the industry off guard, and the modeling firms, that it was more of an afterthought of an area that's exposed and could have a loss of that magnitude. I remember when I think it was AAR's note first came out, I thought they had dropped a zero off of, or they put an extra zero in their loss range. And that still may be the case when the ultimate loss is finally said and done, but I think it does speak to these diversifying regions in the world that don't have great data granularity, the models aren't fully developed, and really because the events haven't come through in many of these areas, that forces the vendor community and the analyst community to go into these areas and build more robust analytics around exposures and damage factors and whatnot. So I think Maria is probably the one that will require the most look back to say, well, what should have been better understood in that loss event.
Okay, great. So what I'd like to do now is move on to sort of measuring performance. Obviously, from an overall Bermuda market perspective, we've seen the market has remained resilient and it's illustrated its success in absorbing very large losses. But how should we all think and investors think about measuring the performance and differentiating the performance between the reinsurers that operate in the Bermuda marketplace at this time? How should people be thinking about evaluating someone's loss announcements in comparison to expectations for losses? Can you share some perspectives there?
Sure. I think you have to look back and see how companies have positioned themselves in terms of their risk profile. Disclosures are quite varied across companies. Some companies provide very detailed disclosures on PMLs, loss curves, distributions. Others have maybe one single occurrence, and so it's very difficult for outsiders to get a true picture of company performance. But some of the crude instruments that the analyst community are using, I think, aren't bad ones, where they'll look at, well, what if companies reported as their PML exposure in the Gulf or in Florida or in other areas, and how does that number compare to the individual occurrences or the aggregation of events that have happened? And that's a starting point, and then from there you then look at, well, what is the relative hits to equity that these events have happened? How does it impact full year's earnings? Those are all different questions that need to be lined up, and then you make a relative comparison. And it's probably too soon to judge fully, because the events are probably going to take a quarter or two in terms of the public reporting companies to see where the dust actually settles and where losses land. But I think you can do some initial work already with public disclosures around risk profile and PMLs and actual results versus their equity base. But maybe the public guys have more to offer there.
Public guys, nice job. Nice lateral.
I think each storm, each one, it is a testament to, as Mike said, the resilience of Bermuda and the capital that's been deployed. Investors are looking at that. We've had some conversations already, and I think that the reactions were, I would say, on the category of good. It was as expected, and there weren't a lot of surprises, which I think is a good relationship that you have with your investors, as opposed to not expected and being surprised. So it goes to the transparency, the disclosures, and the discussions that we have out there. Each storm, is going to develop differently. Whether it's a wind come really flood event with Harvey, whether it's as expected. I think Irma's probably, as Kevin talked about this morning, was probably the one that was the most predictable and more in line with the models that were out there. Whereas Maria, as Mike points out, was devastating. There were times we were looking at it and it was just unbelievable about how much was being engulfed. And as what Mark was pointing out, I was watching 60 Minutes. They need 65,000 telephone poles there to restore power. So there's a tail on that you have to think about the modeling there that's out there and what people are looking at. And then the earthquake, term I've learned is liquefaction. That will have long-term consequences out there as we understand the earthquake development. So models are all a starting point. Probably the most developed model would be Irma, and the ones that probably are developing will be ones that are Maria. The flood event, I think Kevin characterized that, there was 50 trillion gallons of water or as much water in the Chesapeake Bay dumped on Texas. So that's unique. So we'll see how they play out.
Great.
Yeah, I would just add that I think from the outside looking in, it comes down to exposure. And are the reported losses kind of in line on the relativity to the stated PML, let alone to your equity that you've been pushing out? I mean, companies that are knowingly lead with CAT, of course, that's a conscious decision. They're going to have a higher proportion, of equity because that's their business model. But I think others that may have grown substantially, that's a lesson they're going to look at because the marginal margin that they thought they were going to get by growth is dwarfed by putting the balance sheet at risk to that level.
Well, that leads in nicely to the next question, which is around growth and profitability. Obviously, the majority of companies are focused on objectives around growth and increased profitability, and are employing varying strategies to achieve that. But each of those strategies typically require quite a significant investment outlay to achieve them. And on the flip side, we have a continued focus, though, on cost containment or cost reduction at the board level being a significant priority. Could you share some perspectives on how you think and how the industry should think about cost containment and cost reduction in line with investing in some of those strategic objectives to achieve growth and greater profitability into the future?
Same order.
You look like you're ready to go, Mike, so I'll let you go.
As a starting statement, I would say that expense management is not a strategy. It's a tactic or a tool to enhance profitability, but it's not a strategy in and of itself. The shrink to greatness strategy is not one that we have endorsed as an organization, nor is our new owner endorsed as a strategy. Clearly building a globally relevant, large-scale business is an important part of the strategy. You have to spend money to make money. Underwriters, technology, infrastructure, all has a cost associated with that. Yes, you want to be as efficient as you can, but expense management by itself isn't an overarching strategy. It's an important building block for developing above average returns, and it's one that every company needs to focus on. And frankly, I think our industry historically hasn't done a great job because it's easy for somebody to say, well, I'm not going to worry about the expense ratio because the savings there will be dwarfed by deterioration in the loss ratio. And I think that's a cop-out. I think you can actually do both. You can build technology and efficiency without sacrificing quality underwriting and loss ratios. But finding that balance is the challenge that we all face as leaders and managers in our organizations. But our focus is clearly on driving investment in our global platform. And rate helps in profitability. Clearly the events that we've seen should help change the dynamic in terms of girding yourself for another year of 5 to 10% rate declines. Well, I think that, from everything that I've seen so far, is off the table for the next year, and that's across most lines. So that helps when you're thinking about building and growing a business if you're in a rating environment that's at least stable and potentially positive in many areas.
I'll go next. We spend a lot of time focused on where we think margins are, relative and absolute margins, so we can come up with the best mix on the front end, on the growth side, and perhaps how we could leverage some of it on the back end. And those decisions lead you to where you're going to do some investment. And if I just stay on technology as an example, as we've migrated towards a higher proportion of smaller end accounts, that's a whole different ballgame. Yes, it's less volatile and all that, but the endorsement processing and things of that nature are so much more important and so much more a piece of the pie. When you have a big umbrella that you're writing, on an account, generally it's really not auditable. It comes through, it's a bullet, it's subject to installment, and the processing of it is fairly straightforward. When you get into packages and things of that nature, it's just a different beast, and you have to invest differently. And we have done that, but we'll do it where we think not just the year in front of us, but a couple of years in front of us is worth that outlay, because anything with IT takes multiple years to get back. Yep. And then the second thing would be, with us, is the drive-through in analytics, and I think probably everyone on this panel and a lot of areas are doing it, because you get a lot of insights that are initially counterintuitive. And it also can work on low-frequency, high-severity businesses, which was something I didn't think was going to happen. A couple of years ago, when we started, about 3 years ago, Summit, I could see it for the frequency businesses, but for the severity business, I wasn't as convinced. But I got schooled.
Anything particular you want to share that was counterintuitive?
No.
Or is that digging too deep? I thought that might be a stretch.
You want to keep those buttons in a box.
I thought that might be a stretch too far. Bob, anything?
Yeah, I look at the way I've approached it is every dollar that we spend, or yen, or euro, or pound, however you want to characterize it, every investment we make has to be aligned with our strategy. It has to be. If it's not aligned, it shouldn't be in the consideration. And it's sort of a gatekeeper for bringing things into the fold. And as we approach investments, and I look at all expenses as part of investments in our strategy, I kind of put them into 3 different buckets. One is the obvious bucket for growth. Where are we going to drive premium growth? Where are we going to drive top-line revenue growth? Where are we going to drive that piece of it? The second bucket of expense, and you have to have a timeline. You have to look at payback, probability. There's a cost that goes associated with it. You can run all the math on it you want. The second piece, the way I've focused on, is really risk. Risk takes on a number of different sort of perspectives, especially in this industry. The risk on your capital. You have regulatory risk. You have other compliance risks that are out there. There's many different facets of risk, and you can break it down into a number of different categories. But that's a big bucket that I ask people to come to, is put it into one of those 2 buckets. Or a third bucket, which sometimes people get caught up and more wrapped around their axle on, is just efficiencies. Efficiencies do provide value to the bottom line, whether through technology. As Mark was pointing out, they may take a longer term to manifest themselves, but they do provide a lot of benefit to the value, to the bottom line. The whole InsurTech is part of that piece too. That'll provide, if someone can help me define that succinctly, I look forward to that conversation. But the efficiencies are important. So you look at those 3 different buckets. It's not rocket science, but it helps your people on your teams and your companies frame conversations about where you're going to spend money aligned with the strategy.
Right. Each of you have mentioned technology, and Bob, you just mentioned the phrase InsurTech. For me, when I think about InsurTech, it's slightly easier to think about some of the technologies and their direct application to primary insurers, whether it be sensors or wearables, etc. Do you have any perspectives on how you see the disruption or the opportunities that come with some of this technology, on how they may be directly applied to the reinsurance industry as opposed to the primary insurers?
I think it has. We're both insurance and reinsurance as an organization, actually more insurance. There's clearly a focus on distribution. I think where the disruptive element of the buzzword of InsurTech comes in is there a way to disintermediate the intermediaries, and technology that allows you to offer your products and capabilities straight through to the end user or the client it would be the biggest disruptor out there. And I know many companies are exploring just that, alternative distribution models that give us as broker-driven carriers an alternative to only using the broker markets. Mm-hmm. It doesn't discount the importance of the broker markets, but it does give you another tool in your toolkit to get at that expense question. As you think about expense management, the distribution costs of the specialty insurance and reinsurance markets is dominated by the commissions that we pay the brokers, and that there needs to be real value there. I'm not suggesting there's no value, but in many lines and in many markets, the take from the distribution community is disproportionate to the rest of the value chain, and that's something where technology could be quite disruptive to that distribution model. Outside of distribution, there's clearly an opportunity within organizations for process automation, use of robotics and things like reconciliations, data transitions, all of that. There's huge applicability to insurance and reinsurance companies that helps provide the scalability and competitive expense ratios in the business.
Okay. But before I move on, can I just ask you a question there around the sort of the disintermediation? Obviously, there is, it's a significant cost, a significant part of all of your company's expense ratios. But would that disintermediation have other sort of significant impacts on your respective business models? Because one of the ways I think about it is that the brokers own a significant amount of data. And if you were to disintermediate, that would mean you'd get rid of, I think the buzzword around that is information asymmetry. And it would mean that all of you would have the same data. Would that fundamentally, therefore, change your business models?
I think you have to look at it on a line-by-line basis, because I think to suggest that the broker model is going to go away and is not what I was intending by that comment. But by line and by area, particularly in the small commercial side, I'm not sure that the brokers have a particular advantage, other than that they've got arms and legs and boots on the ground everywhere to help distribute that business. If you can bypass that and provide your portals and your front ends to either retail brokers or to the end customer, you're able to capture that data at the front end, and you avoid going through the broker network. It's easier said than done. But it is something that we as an industry need to be examining. If we're giving away 30 to 40 cents of every premium dollar in our own expenses or in distribution cost, is that a value proposition to the end customer? I mean, that's a pretty heavy expense burden to face.
I think some of the examples people are coming up with are, I guess, in a sense, disintermediation. I mean, there's more public data that's available out there that contain customer attributes and other exposure attributes that you don't really need a broker for, where you can validate against what the broker gives you. Not that they're depressing exposures, it's a joke, guys. So I think there is some of that, but from my vantage point, if it was 10 years from today and we're looking backwards at today, I think what's going to really reduce costs and create efficiencies isn't what companies do within their own walls, it's what they do between walls. So the more that you can get connectivity rather than cutting out a lot more of the customer information, the brokers and the value add that they have, laying off a facultative certificate, treaties are a little more difficult to picture, premium audit, all the things that are time necessary to do, time intensive, and sometimes distracting, I think have the best element. Now, I've been around for 40 years, I hate to say. And I've heard this stuff before, object-oriented, business components, structured programming. They'll have the same, I could take 1977 and bring it here, and it would be the same type of lingo that's happening. But some of them are fairly promising, not just because billions is going into it, but it's constructed difference, like a lot of the stuff that was derived from Bitcoin and so forth. Seems to be, the architecture there is pretty interesting.
Yes, there's probably a number of different things. I kind of walked into this one here. I'm not going to try and define insurtech, so trust me. I did try for my wife, and it didn't work out too well. But the way I look at two things that are going to come out of the insurance technology, there'll be efficiencies that'll be gained. Like Mark was referring to, blockchain probably will drive some efficiencies, will be commoditized, and it'll drive out throughout the industry. Value accretion probably will go the other way. But then there's going to be value. And where is that going to provide it? You hear about terms called mega data. being able to capture that data through sensors and other means and bringing it through and actually attack the information asymmetry and create more comparability, you can actually look at that and be able to mine it and be able, I think the value accretion on it, this is Bob, I think the value accretion on that to the company is going to be on being able to better price the capital and being able to be more efficient in using your capital. So one is going to affect the numerator and one will affect the denominator. How that manifests itself out, it's a foot race. And we've seen it in many different areas that were disintermediated, payments industry, out of banking, disintermediated by groups of consortiums that were developed. At first there were 12, then there were 6, then there were 3, and then there were 2. I think you'll see that process over time happen.
Great, thanks. So another avenue for growth is obviously mergers and acquisitions, but this year M&A has been relatively quiet in the P&C space in comparison to prior years. So could I ask, do you feel there's scope for further consolidation in the marketplace, and what do you feel the future direction of any M&A will actually be based upon?
Well, it's speaking from one who has been, I guess, consolidated is a way to describe it. I don't think there's really been a slowdown. I think what you've seen is, certainly from our perspective as a business, Endurance being acquired by Sompo and now becoming Sompo International, that just closed this year. And so although it was announced last year, you have 3 to 6 months from announcement to closure. I think the events that have happened probably put a pause in that, and I think if there's unlikely to be major M&A until you see more certainty on companies' exposures and what does a rate outlook more broadly look like going forward. But the best way to build a profitable business is if you can do it organically with hiring people and building teams, or buying teams and buying businesses. And you have to pay for that. You generally pay a premium for that, and if you can build it without paying the premium, then that's a healthier way to do it. But to take big step moves as an organization, you sometimes do have to take that long forward pass. At Endurance, now Sompo, we've done that many times over our life as a company, purchasing Montpelier a few years ago, now being acquired by Sompo, and now we're in the process ourselves of integrating all of Sompo's international businesses, and that feels a lot like M&A, although it's more internal focused. And we now have the backing of a very large, well-capitalized, low-cost of capital parent that is now getting behind us to help further drive our growth, whether it's organic or through M&A. So I don't see the future any different now than I did 6 months ago, that M&A is going to be a part of our industry. There's too many small companies that lack scale, that lack scalability and lack efficiency, and that is an opportunity to drive value through M&A.
Yeah. So from that, is scale a big driver? Could you balance the view of scale and size versus, say, the importance of diversification in your portfolio?
Well, they're all related. Scalability gets to having a competitive expense ratio, and can you operate leaner over a broader portfolio. The important thing that we focus on in M&A is it has to be a strategic addition that adds long-term value to the company, and the numbers need to work. As finance guys, I think we all probably are very focused on that side of the equation. When you do a transaction, yes, the strategy has to match. It needs to have a future. The numbers need to work, and a lot of times M&A gets done and the numbers don't work. And we're as an organization very focused on making sure that there is improvements to profitability going forward, not just doing it for the sake of printing a large deal.
Right.
Well, as you spoke on behalf of finance guys, well, I'm kind of a backed into finance guy. So with us, and I think it probably is a general rule, the underwriting culture has to be pretty lockstep. The industry is littered with failures that did not properly recognize underwriting culture differences, even on the brokerage side. Let's go back and look at Marsh and J&H. What a colossal failure that was, right? Because of cultural differences. But much more true on the underwriting side. So if you're going in for expense ratio purposes and scale alone, or if you're going in for, have perfect nirvana by, the quality of an investment banker presentation is inversely proportional to the thickness of it. So, and maybe the amount of color used. So I guess the view to me on that is that if I have an under-levered company and then an over-levered company, and I put them together and it's perfectly levered, it's completely the wrong reason. So the last thing in our chain of decision criteria is the financial implications. It's the underwriting aspect first, the quality of the talent, and the financial aspects is third. So, but I do think, as you said, it's going to continue to be what goes on in the industry. But I think depending on what happens in 2018, back to your original question, if this is only a marginal or light, moderate uplift, then margins aren't going to be expanded dramatically. Balance sheets are hurt by cats, and there's increasing reserve cracks in the industry. There's more LPTs out there. There's more reinsurance usage, let alone recoverability of that. There's an increasing stress on the balance sheet, and as more cracks come through, it's going to affect people's operating earnings, therefore it's going to affect their multiples, it's going to affect analysts' view of the industry, and multiples are going to sink, and they lost a good currency, which is their stock, because they have to issue more to buy something.
Yeah, it's hard to add to that. It has to strategically make sense and financially make sense. Cultures are important. We got out ahead of it a couple years ago, 3 years ago, with casualty and specialty by diversifying. So scale is important, but scale also comes with agility sometimes, and you have to be cognizant of that. Scale helps the leverage. Agility is also important in a market that's changing.
Great. Well, we're running down on the clock now, so I'm trying to end with one last question. So we've covered quite a bit in terms of strategic growth and profitability objectives, but what else are you looking at in terms of important market driving forces that are out there that you're keeping a very close eye on, and how it may shape the reinsurance industry going forward? For me, one of the big things earlier at the beginning of this month was obviously the proposal around US tax reform coming through. But there are factors like that you're also keeping an eye on outside of what's going to happen in terms of rate increases and the amount of capital interest. Yeah. Maybe, Bob, maybe I could start with you.
Well, Mike was on a roll.
I see we're going to run out of time before it gets back to me. So
I'm counting it down here. Look, there's all those things. We're obviously, first and foremost, to state the obvious, the rate, changes, come next year at top of mind, and, what are the near-term benefits that will provide vis-a-vis potentially longer term. U.S. tax reform is something that we're looking at. I think someone said this morning, remember, it's only a proposal. So we'll have to wait and see what happens there. I think something will happen. I do think something will happen. I think, though, the way to survive that is looking at your platforms. And platform, again, back to the word agility. We've got a lot of agility in our platform globally. So whatever comes at us, we'll be able, I think, to be able to survive that. But it's top of mind, because you don't know what's going to come around the corner on that piece of it. Looking at how far away from the center will the rates affect? Back into casualty markets, and will that give us a chance to get some opportunities there? And the fourth piece, which does go back to the first one, which is third-party capital. How will that behave? Will it be cheap or will it be patient? If the rate hikes don't come next year that maybe they're anticipating, will they pull back? Or will they wait again through 19? Or if the rate hikes do come, will they come back in mass, which rules of supply and demand tend to cause that to be a bit muted? So we'll see what happens when that cycle comes around. So those are a few of the things, and trying to make sure we stay aligned to our strategy at the top of mind that's out there in a market that's changing that.
That's a great overview. And the other thing I could think of is macro, which on interest rates, that finally starts to move up as the predicted and what's been priced in by the street, and the multiple increases are supposed to happen next year. Okay, yeah, we're going to have mark-to-market hits, on it, and yes, we're going to have more investment income going through and so forth. But I'm actually a little worried about how this will cascade into the minds of the underwriting community, and will the interest rates start to, especially with longer tail lines where interest rates and duration drive the whole decision process, really, is that going to allow rationalization of behavior to cut rates to grow market share? Still thinking the operating return is better. Underwriting results will deteriorate. Operating returns might be better. And I'm a little worried about that.
I was wondering how long it was going to take for interest rates to come up, but that is a critical focus area. And more so that if you think about the last 10 years, there's been nothing more damaging to our industry's return profile than the drop in interest rates that we've seen over the last decade. And you think about how levered we all are in terms of the balance sheets and the reserve leverage that the industry has. That has had an enormous impact on ROEs. And I share the view that you wonder what will happen if we get back to a quote-unquote normal interest rate environment. Does the cash flow underwriting kind of come back onto the table? It seems like a long time ago that became a topic of conversation, but if rates went up 100 or 200 basis points, does that old bad behavior reemerge? I haven't seen any signs of that, but that's clearly something to watch out for.
Well, each of you, thank you very much again for your time and agreeing to share your perspectives today. It's greatly appreciated.